Hi, my name is Paul, and welcome to episode 18 of my monthly stock portfolio series, where I invest $100 of my own money each month into Canadian securities. In last month's video, I went through both MTY Food Group and the Morguard North American Residential REIT's first quarter results and conference calls, and I decided to sell my remaining stake in Knight Therapeutics. In this month's episode, I'll be summarizing the key points that came out of goeasy's first quarter. And as always, I'll be showing you exactly how I'm going to be investing this month's $100. But before we get into the video, you should be aware that there is a link in the description box to the goals and rules that I've set out for investing within the monthly portfolio. And if you happen to be somebody who prefers watching videos to reading, then you can also watch me go through everything in the first episode of the series. So a link to the playlist starting at episode 1 is also available in the description box of this video. Now let's get right into the news. And surprisingly, May was a pretty slow month, with the only news to go over being goeasy's first quarter results that came out on the 10th. First up, I have to talk about the crazy growth that goeasy just continues to report. The company's loan portfolio grew by 38% from Q1 of last year, and this led to record revenues which outpaced the expenses and resulted in adjusted earnings per share that hit $3.10 in the quarter. So profitability was the strongest that it ever has been, and the company has been closing some of its lower margin brick and mortar easy home locations while adding to the much higher margin portion of the business via the addition of more merchant partnerships that offer goeasy's loan products at the point of sale. In addition to that, the company has tons of available liquidity, which will be used to continue expanding to meet the growing levels of demand for subprime loans. But even better than all of that was how the company addressed the elephant in the room. Now, if you've watched either of these two videos, then you're already well aware of the Canadian federal government's decision to reduce the maximum allowable interest rate on loans down to 35%. But according to goeasy, this isn't actually as bad for the company as the market had initially anticipated. See, on the conference call, we learned that this regulatory change isn't expected to actually become legislated until 2024, which means that for the rest of 2023, goeasy will be able to continue making loans above 35%. And since the regulatory changes will be forward-looking, these loans will continue to be legal until they achieve maturation. Now, as good as that news was, it actually gets even better. See, in the company's quarterly presentation, it was explained that through the company's three-pronged strategy of offering newer products, attracting customers with better credit scores, and improving the credit of its existing customers through a positive reinforcement model, the company has managed to further reduce the weighted average interest rate on their customers' loans to 30.2%, which is already well below the upcoming 35% barrier. On top of that, the management stated that they have a post-regulation plan to retain some of their customers with credit scores that would require their loans to have interest rates above 35%. And goeasy is going to do this by very slightly increasing the interest rates on their other customers, which is a move that is not projected to result in significant customer churn, which, if true, will be incredibly positive for both the company and those customers who would otherwise have their borrowing requests rejected. Next, on the conference call, it was announced that the end goal of the company's shift towards a greater number of secured loans is expected to continue until approximately 60% of the portfolio is secured by some form of collateral. And this shift looks to be instrumental in further lowering the average weighted interest rate and reducing the average amount lost on charge-offs. Finally, we were given the company's 3-year future outlook. And for the most part, it looks like the major regulatory change isn't expected to actually change much, since almost all of the key metrics were in line with what was projected last quarter. This was a huge surprise that was likely the piece of news that was most responsible for the share price jumping from $92.44, where I bought 0.6 shares at the start of May, and ending the month at $106.80, for a gain of over 15.5% in just 1 month. Needless to say, goeasy was this month's top performing holding within the portfolio. The next best performer was the Morguard North American Residential REIT, And at the start of May, I purchased 4 shares of the REIT for $17.10 each. And unfortunately, throughout the course of the month, the share price did drop by about 2.51%, or 43 cents per share. But once again, Morguard's monthly dividend pulled through and earned the portfolio $4.08, which turned the slight loss into a gain of 3.45%. Finally, May's worst performer was MTY Food Group. Last month, I bought just a bit less than a full share at a cost basis of $59.36 per whole share. But this month the share price tumbled a little bit lower and ended the month down 2.63%, or $1.60. Now, MTY did pay out its quarterly dividend this month, but the $1.09 that the portfolio earned was not enough to make up for the decline in share price. So, in total, the month's MTY shares ended down 0.74%. Factoring in the performance of all of the holdings, this month my portfolio managed to turn out a gain of 7.23% when including the dividends received, or about 2.25% if we don't count the $5.17 in earned dividends. Now, this month, none of the competing benchmarks were paid out dividends, which allowed my portfolio to outperform the rest of the group. Without including dividends, however, the S&P 500 ETF had the best performance, with a gain of 3.04%. This was then followed by my portfolio, and then that was followed by the Global Value ETF, which declined by about 0.8%. Meanwhile, the Canadian All Cap ETF declined by 3.75%, and the worst performer of the month was the Canadian Large Cap ETF, which slid 4.25%. So, all in all, my portfolio performed pretty well relative to the competition this month, especially when considering how much the broader Canadian markets have dipped and that all the securities held within my portfolio are Canadian. That said, without GoEasy's standout performance, my portfolio would likely have performed pretty well in line with the two Canadian benchmarks. And if we take a look at my total portfolio performance, where GoEasy has a relatively small weighting, from January 2002 up until June 1st, 2023, so far I've invested $1,731.94 in personally contributed capital and dividends. And as of the market's close, the value of my portfolio is now sitting at $1,687.53, which is a loss of $44.41, or 2.56%, which is a very slight improvement over last month. And you can clearly see this by looking at the green line on the graph here. This graph shows how much was gained or lost net of contributed capital for my portfolio, as well as for each of the benchmarks, and my personal monthly goal. Unfortunately, from a competitive standpoint, over the last few months, things haven't exactly been going ideally for my portfolio. But at least I've managed to get back out of last place. Though, to be fair, I am practically neck and neck with all of the benchmarks, except for the S&P 500, which really had a breakout month when compared to the competition. That said, things can change pretty quickly in the world of investing, so we shouldn't focus too heavily on the short-term variance. And like I've often said, it's important not to get dissuaded when share prices don't match your analysis of the underlying businesses that you're investing in. See, if you're going to be investing in individual companies, there will be times where your opinion and the market's opinion don't align. And when this does happen, you need to be aware that the market does horribly misprice securities from time to time. And sometimes these mispricings last for quite a while. So, unless something has significantly changed one of your key reasons for investing, you probably should not be upset about holding on to a bargain stock, even if it drops or sits still for several months or years. Instead, you should take solace in the fact that the underlying value of a security and its share price always find a way to meet in reality when given enough time. So, hang tight and trust in the work that you've done to fully understand the real value of your investments. Having said that, the price of GoEasy has risen pretty dramatically since having bought in. And GoEasy is a company that I believe has a couple of major risk factors that, if they play out, bankruptcy could ensue. So in order to compensate for this risk, I require a more sizable discount than I would for investing in other securities with less harsh risk scenarios or less likely risk factors. And despite having very positive earnings, these earnings didn't significantly impact my long-term outlook on the company. But the price that I'd now have to pay for the same long-term risk-reward ratio has increased. So at $106 per share, I think I'm going to be better off investing in MTY Food Group, since it offers a more certain long-term reward. Although, given the information that I've used to come to this decision, it is a pretty close call. Noting that, when there is a close call, I generally would want to lean towards the investment that I'm more certain to have a positive outcome in. So, for that reason, this month I'm only planning on investing in two companies, the Morguard North American Residential REIT and MTY Food Group. So, now I'm going to hop into the Wealthsimple portfolio and start buying. Alright, I'm inside the Wealthsimple account now, and I have $105.17 to invest. And I think I'm just going to be going with Morguard and MTY, since GoEasy's price is a little bit outside of where I'm interested in purchasing at. So we're going to buy our usual 4 shares of Morguard. And confirm that. And it looks like we have $37.49 left to spend. So I'm going to invest all of that into MTY Food Group. And that's probably going to take until the end of the day to clear, so I will be right back. Okay, I've just received an email confirming my purchase of 4 shares of the Morguard North American Residential REIT for $16.92 each, as well as 0.639 shares of MTY Food Group at a cost basis of $58.69 per whole share. And after these buys went through, my portfolio was left holding no cash at all. So, as of the market's close on Friday, June the 2nd, my portfolio holds 76 shares of the Morguard North American Residential REIT, worth about $1,272. The portfolio also holds 5.98 shares of MTY Food Group, worth approximately $351. And finally, I have 1.62 shares of GoEasy, worth a touch over $177. And like I said before, there is no cash currently being held within the portfolio. Moving on to the dividend tracking segment, both Morguard and MTY paid dividends during the month of May, and in total I received $5.17, with $4.08 coming from the REIT and $1.09 paid by MTY. This marks the first time that the portfolio has earned more than $5 within a single month, and now that we have Sir Wilfrid Laurier in our back pocket, we might actually be able to make a dent in the cost of living. Well, not really, but this is the first month where we can actually afford to make some almost BLT sandwiches. We just have to give up on the idea of having lettuce, because that would take us way over the budget. But one day, eventually, we will be able to enjoy a full BLT while also being able to afford the cost of living. And all of it will be on the back of this portfolio. But until then, I'm just going to keep looking on the bright side of things by acknowledging the little milestones. For instance, the dividends that we earned this month amounted to more than the total received in the first 7 months of running the portfolio combined. Also, even though we just finished up with month 5 of the second year, the portfolio has already earned more dividend income in those 5 months than were earned in the first full year of the portfolio. Plus, since inception, the portfolio has now returned a cumulative $37.11 in dividends. Keeping all of that in mind, next month will be a bit of a step down in income, since only Morguard will be paying out a distribution in June. But after that, we will have 2 back-to-back months of quarterly dividend payments from GoEasy and MTY Food Group, respectively. So the portfolio will be back to achieving record months before you know it. Now, if I were to just leave the portfolio as it is and collect the dividends in cash for the next 12 months, assuming no changes were made, I would expect to receive $66.93, which is a 5.55% increase from last month. So the monthly portfolio's yield on contributed capital is now sitting at 3.72%, and it will probably stay pretty stable around this percentage range until some big dividend news comes out, or I decide to make some more changes to the current portfolio. However, I don't really have any plans to do that currently, so I think that's all that I have to say for this episode. Really quickly though, please remember that this video is not financial advice and that I am not a financial advisor. This video was made entirely for the purpose of providing inspiration and insight into my personal investment decisions, and it should not be used as a substitute for doing your own research. This video does not have the information required to make investment decisions on individual securities. So again, I am not a financial advisor, I'm just a Canadian who likes to invest and share my opinions with others. And in doing so, I hope that I was able to provide you with something of value. And if I did, then please consider sharing it with anyone else who may also benefit from it. Thanks for watching all the way to the end, and enjoy the rest of your day.